Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. UAE time, and oil markets trading in Asia for a few hours, and we have Brent crude oil at 83.45, essentially unchanged, up a few pennies, and ultimately unchanged, really, for if you go back to the 1st of May, oil prices were pretty much exactly the same. They closed on the 1st of May at 83.44. We're 1 cent above that. This market is looking for direction. Osama Rizvi, energy and economic analyst, Primary Vision Network in Pakistan. Osama, obviously a lot of news overnight, confusing news around a ceasefire in Gaza, Israel's invasion of Gaza. The Hamas accepted the ceasefire terms, and then Israel seemed to indicate that it was no longer acceptable to them. In your thoughts, are we at the end of the beginning of this war, or are we at the beginning of the end of this war?
That's a very interesting question, Sean, but I believe that at this point, it might be too early to say anything. Unfortunately, the recent event, I was hoping that the atrocities would end and there would be a ceasefire, but that did not happen. So there is no telling what can happen next. I mean, as long as we have an open geopolitical front, not only this, but also Russia, Ukraine, the chances of an escalation and that translating into a sudden spike in oil prices is always there. But if you look at the fundamentals at the moment, even the fundamentals and at the paper markets, there is no indication of a price rally. The commercial crude inventories in the US are at almost the same level as they were last year. They're right at 10-year seasonal average. If you look at the hedge fund and money managers, they've been actually selling their long positions, about 95 million barrels in the last week. So, I mean, in terms of the physical markets and in terms of the paper markets, the traders do not see any further disruptions. That is only until there isn't any escalation. But as recent events have shown, I believe, unfortunately, it's my intuition that we might see further escalation and chances of a rally. But that does not mean it will cross the triple-digit territory.
Jamie Ingram, senior editor at Middle East Economic Survey based in London. Jamie, 3 weeks out from an OPEC meeting, OPEC Plus meeting, the sort of biggest one this year in person in Vienna. As the oil producing countries meet and reflect on the first half of the year, has it been a good story or a bad story for them? Oil prices are up 10%.
I'd say you'd have to say that it's a relatively good story for them, Sean. And good morning, good to be here. Certainly from a narrative perspective, generally the positioning of the oil markets has been all about the sentiment, the geopolitical issues, the risk premiums, rather than any narrative of OPEC is withholding crude oil from this market. OPEC is increasing inflationary pressures on economies in the West and on emerging economies. So I think that has to be a good narrative as far as OPEC is concerned. Prices have been relatively surprisingly stable considering all of the geopolitical risk that abounds in the market at the moment, and they're stable at a relatively high level. Aramco just announced their results. It was something, they averaged just over $80 a barrel for their crude in the first quarter of this year. That's a solid metric by any means. OPEC can be content with where prices are heading into that market and into that meeting. Obviously everybody's wondering what the OPEC Plus members that have voluntary cuts are going to do. I would say that the prospects of those cuts being unwound at this meeting have reduced in recent weeks, the recent week or so, really, as prices have softened somewhat. As Osama mentioned, inventories are at a pretty relatively seasonal average kind of level at the moment. The market is softening a bit, so that all points to OPEC kind of playing it cautious and keeping those cuts on the table for now.
Andy Lavin, senior partner at Econs. Andy, if you're looking at this market as we are trying to look beyond this geopolitical risk premium, this geopolitical risk narrative that's been with us some time, and we saw a lot of it sort of being drawn out of the market last week. As we look beyond that, what does the fundamentals of this market look like to you?
Oh, goodness me. That's, as one of your stories says, is the $9 trillion question, Sean. I think the challenge for everybody is that it is not clear where the whole market is going. It's becoming increasingly difficult to understand and almost rationalize different people's opinions about demand. For example, you take OPEC and the IEA. They're almost contrary, you could say. And I think the challenge comes down to what assumptions are you using and what are the error bars on those assumptions. So I think what we see is an enormous amount of uncertainty, which takes us right back to where you started. The market is looking for direction. And historically, if you go back 6 to 9 months, direction came from, oh, a Ukraine-Russia war, therefore this is going to happen. Oh, we've got Israel-Palestine, oh, therefore this is going to happen. None of that fundamentally has changed. I have to be careful, the supply-demand balance. That's not strictly true because Russia's been going on so long. There have been changes, but it's not a really big change as we saw, for example, when Iraq was invaded and the whole thing shut down. So I think the long-term story is, where is the demand for oil and oil products going to go? Do you believe in the OPEC narrative that says it's going to be here for years to come and it's going to keep growing? Or is it going to go down the IEA path, which is actually the developed world is going to have to kind of lead the energy transition and pull demand out? The two will have to come together. We cannot continue to have two views of the future. At some point, they will start coming together in reality. And unfortunately, until we get that, I think we're going to stay, in terms of the overall supply-demand balance, in the world of uncertainty.
Osama, as we look to these big events in Europe, in the Mediterranean, obviously the war in the Mediterranean and Gaza, the war in Europe, in Ukraine, it's all west of Suez, turmoil, leading candidate in America who's ahead in the polls is on trial, etc. Looking to the east of Suez, to our neighborhood and towards you and beyond, we've an election happening in India, everything going smoothly. We just had a change of government, new election in Indonesia, in Pakistan not long ago. Singapore's just changed its leadership. Asia looks rather smooth, predictable, and stable as compared to Europe and the Atlantic basin at the moment. Your thoughts on the outlook for that, and can Asia seek an opportunity from that, or is that a misreading of the east of Suez landscape?
Well, I would partially agree with that. We might have seen some sort of some signs of stability, some symptoms of it, but if you look at the overall global economic indicators, most of them really have a disproportionate impact on our economies. Like, for instance, Pakistan or the developing countries, as it is said, our dollar, your problem. So until unless the Fed really decides its monetary policy direction, things will look pretty unclear here and unstable as well in terms of the debt. The public debt has also risen by unprecedented amounts recently. Climate change also continues to play its huge role. For instance, in Pakistan, sitting right now, we have had a huge wheat prices where, for 3 days from now, nationwide protest has been launched by farmers. It was formally announced just moments ago, so that wheat price is also playing out. Food price inflation remains an issue. So all of these factors, the global economic factors continue to impact our economies. So I'm not really sure that we will see a stable path. We can also see this happening when we look at the crude oil imports in April, heading to Asia.
I suppose everything denominated in dollars has to be painful for weak Asian currencies.
Yes. So, crude oil imports have also dipped. Pakistan, as I said, we're seeking another IMF bailout. So I would be hopeful, but still look out for these main indicators. But China has been really doing pretty well recently. The PMI indicators has been continuing to post some strong growth from the past 2 months at least. So that is good, at least for the global markets. But other than that, we'll remain cautious.
Jamie, we're at 83.45 on Brent, essentially where we were for much of the first quarter. That was kind of the ceiling in the first quarter, high 70s, low 80s. And second quarter now moving towards the second half of the year. Does this look to you like a floor or a ceiling as the price has fallen back to where it's sort of sat comfortably in the first quarter? There's a lot of talk at IE Week and then in Lausanne at the FT Commodity Summit that the second half of this year would be a very tight market if OPEC maintained its cuts. But it's hard to see that stress in the oil price at the moment. Does 83.45 feel like a ceiling or a floor to you?
Well, Sean, as you quite rightly mentioned, the big word OPEC there. I think that if under the current status quo, if OPEC plus cuts remain as they are, then yes, $80 is probably a floor. It's very hard to see a 7 handle on it at the moment. But clearly, if OPEC plus decides that they are going to begin releasing volumes back onto the market, we could quite easily see momentum push prices back below $80 a barrel. So I think that OPEC is clearly the biggest variable when assessing the near-term oil price outlook, really.
And are we seeing, I mean, from the point of view of being sort of focused on the crude price and the ample supply, whether it's in production or the idle supply, 6 million barrels on the sidelines, but where is the sort of distillates as we go into the summer driving season, big travel, tourism season, aviation fuel expected to get a bump? Where's refining and the middle distillates look like? Yeah,
it's an interesting one at the moment. The big Middle Eastern producers just recently produced their official selling, their next batch of OSPs, the official selling prices, and as expected, the kind of heavier grades, they had big premiums placed on them, as we're seeing a bit of a tightening for that. Well, the distillates market is tighter than the light ends market, and also the OPEC plus cuts typically fall on the heavier end of the spectrum. But then we saw Saudi Aramco, for their extra light, they increased the price of their OSP much more than was expected, which was interesting, given that we are definitely seeing a weakening of that light ends market as gasoline has disappointed. And also there's significant volumes of other light grades such as Murban, which has been backed out of Abu Dhabi's refining system because of refinery upgrades there. So the distillates, the refined products market is definitely a lot more interesting, I would say, than the crude oil issue at the moment. But yeah, it's weaker than expected.
Andy, just picking up on that and sort of looking at sort of some dot connecting here. Saudi Arabia, as Jamie said, increasing their OSPs into June, even though prices are declining, if you like. It seems like a weaker, softer demand picture. China looking a little bit soft. And I wanted to connect the dot to Saudi's recent announcements, even last weekend, about backing away from some of their massive 2030 commitments in terms of the development of NEOM and other what they call giga projects, basically projects costing hundreds of billions of dollars in their development and transformation of Saudi Arabia. How do you see the interconnection of those 2 points? Because for a long time, it seemed like Saudi would have to do everything it could to keep the oil price up in order to meet those goals. Now those goals are dissipated. Does that mean Saudi's target has softened a bit?
Oh, goodness me, that's a really complicated question. So first of all, essentially the OSPs are premiums, so they're not defining the absolute price. They're just absolutely looking at the premiums. The production levels are what they use to kind of move the absolute levels around. So really all they're doing is basically saying we expect in the next few months demand for these products to go up. That's really what they're saying. And I
Which
think
is not unreasonable given the time of year.
Exactly, right? I mean, it's the summer season. People go on holiday. Even in what's going on in the world today, people will go on holiday. Even in the US, people will go driving on holiday. So there's no reason to suggest that the general trends from history won't happen. Now, I've seen various kind of stories around, let's just pick on NEOM, various stories around NEOM. And I think you almost need to peel back the layers of the onion and actually really understand who is really saying how much is actually going to be paid and how long is it going to be and how much are they going to build. I think there is a realization and that the amount of money they needs to come from the outside. It cannot come from within Saudi. It cannot be funded by their economy. And that's, probably shouldn't be a surprise to any of us. The UAE
every country needs FDI, right? Every country needs foreign direct investment.
You look out the window, Dubai has been built on the back of external capital investment. Yes, the government puts money in, it decides where it puts the money, but it does a very good job attracting foreign investment. And I think that's what we're starting to see now in terms of some of their giga projects. And when you start talking externally about projects, you have to be listening to the people that you think are going to give you money. If you said, I'm going to build a stairway to the moon, people would laugh at you. If you start talking about some things that are more realistic, even if they're aspirational, people will listen and they will kind of go, oh, that might happen. Where do I put my money? Okay, what do I need to do? And I think that's what we're in. We're in this phase of they've cut the first piece of ground. Now they're going out and trying to find out how do we encourage external investors in. And yes, when we do that, we can't talk about Stairway to the Moon. We have to talk about a 4-bedroom house, a 5-bedroom house. It's got to be realistic. So I don't actually see there's a connection, really.
Well, I mean, it's only 2 weeks ago less, the IMF reported that they see Saudi needing a fiscal break even of $96.20 on their budget. And so there's clearly a big need for a lot of oil revenue, because that's the only thing that is going to deliver that. And if you back away from these hundreds of billions of dollars projects, maybe that fiscal break even comes down. Maybe that target oil price, that very tight oil supply strategy can back off a little bit. That's kind of at least the tea leaves to look at. But Osama, I wanted to come back to a story we've talked about before, which is the energy security issues with Pakistan and the potential that Iran could meet that. We've got a sort of reemergence of the idea of the Iran-Pakistan gas pipeline project. Yesterday, Iran's consul general to Pakistan said that this project could still have legs. Your thoughts on that as a possible project that still could move forward as part of Pakistan's energy security solution? Osama?
It's very complicated and it's a very... Can you hear me?
I can hear you now, yes.
Can you hear me?
Yes. Yes.
Okay. So sorry for this. Yeah. So I was saying it's a very complicated issue. Pakistan has reserves falling down, but at the same time, I believe, this is a personal point of view, that Pakistan do not have the diplomatic space or the sovereign space at the moment to really engage with Iran with its sanctions and all of those. Recently when Iranian president visited Pakistan, they were sanctions.
Sorry, that line is dropping in and out. Osama, the line is dropping in and out. What I might suggest is that you turn your camera off and just go audio, as it might give you the bandwidth you need. Let's go to this survey question, which is where we started our conversation this morning, regarding events in the Gaza. What stage is Israel's war on Gaza at after 7 months? It is the 7th of May. This all started on the 7th of October. Is this stage at are we at the end of the beginning as we set Israel's, just took over the Rafah crossing, which is the only entry point into Gaza that Egypt was, from Egypt, where the aid was still coming through. just today, for the first time in this 7 months, Israel has taken that and has started bombing into Rafah, which is, of course, full of refugees of refugees of refugees. So is this the end of the beginning of this war, or is it the beginning of the end? It might be many other things in between, but what does it feel like from a definition point of view? Beginning of the end or the end of the beginning? It seems like patience in Washington is running short. Are they willing to use their leverage? That is the question. Jamie, just picking up on that point that I was talking to Andy about, your thoughts on the sort of macro picture in Saudi Arabia, the driver of OPEC plus, the driver of the strategy of curtailing supply, of course, with partnership from Russia and also from others. But ultimately, they are the driver of this. Does the change in their strategy from what impact do you think the change in their 2030 vision strategy and commitment could have on the OPEC plus policies that have been followed over the last few years?
Thanks, Sean. It's good to circle back on this one. Yeah, I mean, just going back to the, what the IMF was saying about the oil price that Saudi Arabia needs, I never put too much credit on those numbers, to be honest. As you say, budgets are always very flexible. How much do you spend here? How much do you spend there? But it also overlooks the fact that Saudi Arabia is perfectly happy continuing to run up deficits for quite a while yet. They have very low debt levels. They can afford to borrow at a reasonable rate on the market and run deficits for quite a while yet. Also, as Andy was saying, the plan is and always has been that a lot of these projects would be financed by foreign direct investment. So again, the key onus is on bringing in money into the country rather than relying on your oil to fund everything there. And they also have a lot of foreign reserves that they can continue tapping into for quite some time to come. But yes, obviously they do, in order to make ends meet, they do need a relatively high oil price at the moment. That probably does filter into some of their OPEC plus calculations. Certainly they are less willing to countenance a all-out market share war that pushes prices down into 70s, 60s, or even below, were they to really tap into their spare capacity than they would otherwise be. I think when it comes to a lot of these projects, as Andy was rightly saying, it's about the marketing of it. They've been very maximalist with a lot of the projects, such as NEOM, and how they characterize them to the world. Robot cities, these twin towers at NEOM that are going to stretch across half of the country. That looks very great and gets a lot of buzz out there, but a lot of people have doubts about that. Whereas if you characterize it in a different way about a new industrial facility, new industrial logistics facility that is well situated just off the Med, that is very attractive. If you talk about the hydrogen project there, investing into new clean energy technologies, that's very attractive. So there's a lot of ways that they can bring in money in that way. It's all about the marketing. I think we're going to see a bit more of a pragmatic side to how they start selling these projects now.
Osama, just coming back to you on the question we were talking there, the reemergence of the topic of Iran-Pakistan gas pipeline.
Yeah. So am I audible now? I hope so.
Yes, you are very audible. Yes.
I was mentioning that Pakistan at the moment stands at a critical juncture. We are in contact with the IMF. We just got another bailout package. We are working to default. So I think Pakistan may not be in a position to really engage in such a diplomatic adventure with doing something formally with Iran. We saw that two Chinese companies that provided technology for ballistic missile program in Pakistan was sanctioned by the US. But on the other hand, if you look at the smuggling point of view or the informal sector, around 30% of the diesel market in Pakistan is engaged in smuggling from Iran. Around 10 million liters of petrol and diesel is flowing into Pakistan on a daily basis, causing a loss of about 224 billion Pakistani rupee on an annual basis. So this is
sorry, just slow down a little bit. What did you say there, that last smuggling piece?
I mean, about 10 million liters of petrol and diesel is smuggled into Pakistan from Iran. And that causes a loss of about 227 billion Pakistani rupee on an annual basis. So while we do not do or engage with Iran on formal basis, informally or through smuggling channels, a lot of these transactions are already happening. But I think Pakistan would and should take its time, and this might not be the right moment to formally do something with Iran in terms of energy security. There might be serious consequences.
Andy, the flows of new crude flows out of Russia that have been coming east and offering countries like Pakistan that, the Pakistan wasn't able to take too much advantage of it given their own financial challenges, but the flows of new crude flows from Russia into the east of Suez, and the idea of the products from the Gulf moving to the west of Suez. Now, sort of 2+ years into this change, your thoughts on that bedding in as permanent, and where are some of the longer term consequences of that looks like from the point of view of competition in the Asian markets?
So I think you need to go back to the reason for the changes. So the reason for the changes was fundamentally sanctions and an oil price cap. Okay. If you remove the sanctions and you remove the oil price cap, the world will go back to where it was before, i.e. the crude will find the best economic home for it. So the person that will pay the most will get it. Okay, so unless Russia wants to be particularly foolish and decide to sell it to people at a discount because they bought it from them whilst there was all the sanctions and stuff going on, unless that happens, it will return to where it was. So the reality is that oil will go to the developing world, it will go to the developed world, it will go to Europe again if everything sorts itself out. So I don't think it's a long-term trend at all.
Jamie, just last word to you. I wanted to get your comments on developments in Kuwait. I know it's a country you follow quite closely, particularly in the refining area of things. We've had some sort of significant changes in the leadership of the Kuwait national energy industry, which is something that doesn't really happen very often here in the UAE. In Kuwait, there seems to be a lot more movement, not only on the government level, the cabinet and so forth, but also in the leadership of its national oil company. Kuwait announced a few weeks ago that Wahda Al-Khatib, the CEO of Kuwait National Petroleum Company, the refining company, would also serve as CEO of KIPIC. I wanted to get your thoughts and insights on these changes. Does it signal anything to you regarding the Kuwait Petroleum Corporation, as it's called, the sort of national oil company of Kuwait? Any difference in their aspirations?
It's all part of a strategy that they've had for a while now, Sean. KPC, the kind of state umbrella company, has an awful lot of subsidiaries operating underneath it, some of which overlap quite considerably. So the two that you mentioned, KMPC operates the downstream within Kuwait, so refining and petrochemicals on there. But KIPC operates the Al Zour refinery and the Al Zour LNG import terminal. That was set up separately, hyped out from KMPC a few years ago, and KPC has looked at bringing it back to merge it with KMPC for a while. This is the second attempt that they've kind of made to do this in terms of merging the CEOs as a first step. Didn't work last time around. It is still on the books for them. We'll see if they have any more success. There's some MPs have criticized these kind of moves in the past, so we'll see if the Kuwaiti Parliament, which is notorious for its efforts to kind of obstruct government initiatives, we'll see if we're going to have this merger anytime soon. But yeah, that is the plan, to merge them. But the strategy remains the same under the KPC leadership. This is an issue they've been looking at for quite some time.
I mean, the reason it drew my attention, and I want to get your thoughts on it, because historically, within the context of OPEC, Kuwait and the UAE have always kind of moved, been at the same level of production, obviously then the same quota and so forth. But Iraq, which was also fluid but moved way ahead of Kuwait and UAE some years ago. Now the UAE is leaving Kuwait behind as the UAE moves towards a target of 5 million barrels per day capacity. where is Kuwait's aspiration to stay in on the level of the UAE, or is that no longer even possible in terms of that scale of new capacity build? Is this in any way connected to that kind of aspiration?
This is very separate from that aspiration. In an ideal world, yes, they'd want to keep up with the UAE, but their targets are now below where the UAE stands on 5 million barrels a day target. So yeah, it's a great aspiration, but we've seen Kuwait's clout within OPEC Plus start to reduce as its production and most importantly, spare capacity has dropped below what used to be a peer, the UAE. But yeah, they're not catching up with them.
It'll be interesting to keep an eye on whether Kuwait, has an accelerated advance moment like we saw in the UAE over the last few years with the new leadership that took over ADNOC 6-7 years ago. It came with a very big new vision. Could KPC possibly deliver that? What stage is Israel's war on after 7 months? It seems this room is divided between end of the beginning and beginning of the end. Let's hope it's number 2, but I'm still always concerned it's number 1. We'll post that on social and see where we get further insights. Thank you so much, Jamie Ingram, as always in London, Andrew Levin here in the UAE, and Osama Rizvi in Pakistan. Really great to have your insights today. These are critical days if indeed the oil price isn't moving very much. There's a lot of drama around it, and we'll have to see how it plays out. Could be some big hours and days ahead in context of Israel's invasion of Gaza and whether indeed a ceasefire is there. The absence of one, you would expect, if that all falls apart, the return of possible geopolitical risk premium, which we saw last week, was $6 or $7 dropping out of this market with that return. All the best. Thank you, everybody.
Thank you, Sean.
Thank you.